Welcome to the broadcast. My name is Marty Schenkman, and I'm joined by Bob Keebler and Jonathan Blotmacher. And our primary discussion today is going to be about the PPP Paycheck Protection Program loans. Lots to talk about, lots of developments, lots of uncertainty. I've gotten more emails on this webinar and questions that people want to address than probably all the webinars I've done before my entire career. So clearly something that's affecting many of us. Before we officially get started with the webinar, I want to give a minute to each of our sponsors to say a quick word. Vanessa?
Hi, thank you, Marty. Hi, everyone. This is Vanessa Kanega. I am the president of Interactive Legal. Thank you for joining us, and I'd just like to thank Marty, Jonathan, and Bob for presenting this important and timely information. I'm sure we'll all get a lot out of it. If you are interested in additional education, in particularly regarding, the trends right now during this pandemic, or other trends in estate planning, please visit our events page at interactivelegal.com. And of course, if you're interested in learning more about our drafting systems for estate planning and elder law attorneys, please contact us at the information there on your screen or visit our website at interactivelegal.com. Thank you very much.
Thanks, Vanessa. Nicole from Peak Trust, our second sponsor.
Hi. Yes, thank you, Marty. Welcome, everyone, and thank you for attending today's webinar. My name is Nicole King. I'm a trust officer here at Peak Trust Company, and we are pleased and honored to be able to sponsor today's presentation. I'd like to take this opportunity to tell you a little bit about Peak Trust. We serve individuals, families, and their advisors by offering tax-favored trust status in either Alaska or Nevada. We are a full-service trust company, and we offer flexible and customized administrative services for all types of trusts. If you have any questions, please do not hesitate to contact myself or any member of the Peak team. Our contact information can be found on the materials for this program, or you can browse our website at www.peaktrust.com. And with this, I'll turn it back over to you, Marty.
Thanks, Nicole. As has become my custom on all of the programs that I've been doing, I like to give a quick opportunity for Charity to introduce itself to all of the advisors on these calls. And Jane from the American Brain Foundation, are you on?
Yes, I am. Thank you, Marty. And it's an honor to be associated with this. Thank you very much for including us. The American Brain Foundation is a national charity that supports research to cure brain diseases and disorders. And our research partner is the American Academy of Neurology, which is the world's largest association of neurologists and neuroscientists. Because of this partnership, it means that we fund only world-class research in Alzheimer's, multiple sclerosis, epilepsy, Parkinson's, stroke, brain tumor, and many other brain diseases and disorders. I just invite everybody to visit our website at americanbrainfoundation.org, and please feel free to contact me directly with any questions, and I'd love to field those. Thank you very much. Marty is a member of our board, and we're very proud to have him as a part of it. Thank you.
Thank you, Jane. So now we're going to get to the heart of our program and talk about the Paycheck Protection Program. Before we jump in, I just want to take a quick second. I am trying, and I've had wonderful help, which is gratefully appreciated from Jonathan Blotmacher and Robert Keebler, to do a number of webinars to try to help colleagues during this very difficult time. Jonathan and I are doing a webinar tomorrow where we're going to talk about estate planning techniques that are really valuable to use during the current environment. SPAT, STAPs, hybrid DAPs, split purchase trust, GRATs, and SLAT. That's tomorrow at noon, April 14th. Monday, April 20th, we're doing a very interesting program on, we're promoting it as peak performance, but it's about mindfulness. And honestly, with all the incredible stress going on in the world today, worrying about your health, your family, and loved ones' health, and the economy, that's something on Monday, April 20th, that you may want to sign up for. April 27th, also Monday, we're doing another program on technology. I know a lot of us are struggling working remotely and haven't done it much in the past, and certainly not under these circumstances. So we're going to bring in another webinar to all of you on tech. And on Tuesday, April 28th, we're going to be doing a program on planning for Latter-day Saints, another in the series on religion. So without further ado, Jonathan, do you want to just introduce our topic today that's so important? Jonathan?
Thank you, Marty. Welcome, everyone. It's an exceptionally trying time for everyone. And yeah, Marty, can you hear me? Marty, can you hear me?
You're good, Jonathan.
You're kind of garbled.
Jonathan, you're good.
Jonathan,
I am good or not, Bob?
All right. Let's just get started on slide 7.
Bob?
You are Bob, Jonathan, but you got to start presenting. All right, Jonathan's obviously having a technical issue. So
Can
let
you
me
hear
just
me,
get
Marty?
started on slide 7. Tom, if you could call, see if you can call Jonathan and tell him to dial back in. On slide 7, the Paycheck Protection Program, PPP, and loan forgiveness are intended to provide economic relief to small businesses. I think everybody's aware of that. The real issues are how do we handle it and what do we do about it, and we're going to get into that in the webinar. One of the things that's very important in the middle of slide 7, and they've already updated it at least once, the IRS put out a series of FAQs, frequently asked questions, on this topic, and they have updated it, and they indicated they will update it on an ongoing basis. Given the myriad of unanswered questions and issues that we all have on the PPP program, I suggest that you periodically go back and check that out. The last bullet point on slide 7 is also very important, and this was addressed in FAQ 17 on the most recent batch of FAQs, and it's very important. The rules have changed substantially. There were periods of time where it wasn't clear if you had to reduce gross wages subject to the calculation for FICA and other taxes, and now you don't have to. One of the problems that as practitioners we all have is if we help the client, or even for our own firms, prepare an application and then a new interpretation came out, and Bob Keebler will comment in a minute about some of the regs that we're waiting on because we desperately need more guidance. What it said was that you rely on the rules in effect when you filed your application. So if the application has changed, if the rules have changed, you do not go back and change your application. Now, one of the other things to keep in mind, we're going to talk about it again, but it's very important. Once you've submitted an application, you cannot resubmit. There's no 2 bites at the apple. So if something is unclear, and if it's for a client, you certainly want them to sign off. If it's unclear, you may want to take the more favorable interpretation, because if a later pronouncement comes out and says the better interpretation works, like not deducting by FICA tax, you can't change your application. You have to use the laws in effect or the rules in effect when you applied. On the first program that Bob and I did, it seems like ages ago, it's probably only a week ago on the PPP program, we were debating this FICA tax reduction. It made no sense to either of us, but it seemed pretty clear that it was called for. Now, if that's the case and you filed reducing the wages, you can't refile. Let's go on to the next slide. Bob, let me turn slide 8 over to you. Bob?
Well, thank you, Marty, and good day, everyone. So we have this Paycheck Protection Program, which is, I'm here, Marty. Can you hear me? Marty, can you hear me?
I hear you, Bob.
Hello, Marty? Hello, Marty?
Yeah, Bob, talk.
Okay, let's just start. Let's start with this Paycheck. I'm trying, Marty. Something's.
Bob, just do the program. We hear you. Bob, just do the program. We hear you.
Okay. On page 8 of the materials, we're talking about basically the program was allocated $349 billion, and most of this will be forgivable. That's what we're hoping for. Now, the loan terms are identical for all borrowers. This is any business concern, nonprofit, veterans organization, or tribal business, not more than 500 employees. And what we're looking at here is there are special definitions for the exceptions of when you have more than 500 employees. So we have some clients that will fit even though they're greater than 500 employees. That's important to know. Now, when you look at the next page, up on page 9, please, what we're looking at here is, and if somebody could please bring us to page 9. Okay, on page 9 of your materials, eligibility details. Self-employed and independent contractors are eligible. So a self-employed person is going to be eligible. They have not given us regulations yet on how this is going to work for self-employed and independent contractors. There is special eligibility for restaurants. Let's say a restaurant chain owned by one person has 1,000 employees, but there's not more than 500 in any location. They're still going to be eligible for this program, so that's a good thing. Now let's look at page 10. We're going to bring Marty back here. Marty's going to walk us through some of these definitions.
What is a small business and what's a nonprofit?
Okay, until Marty gets back, let me just, I'll teach the slide.
Definitions of citations if you need to look it up to see if a client. Bob, I'm going to assume that everyone can hear me. I'm sorry about the technical issues. The definitions of small business
Marty, I can
and
do it.
nonprofits are on slide 10, and they're addressed in FAQ number 3 if you need more information on it. Bob, why don't you pick up on slide 11?
Okay, now, so we have something called an affiliation rule. Just for those of you that are tax practitioners, cross out the rule affiliation and put in your head attribution. Okay, so I'm here, Marty. I'm talking. Everything should be okay. Now, borrowers apply these affiliation rules that are set forth in the SBA's interim rule on affiliation. So there's SBA regs, and then there's an interim rule. And basically what they're trying to get at is if you own 5 or 6 businesses, each has less than 500 employees, but more if you add them together, they're going to have more than 500. Then what you're going to have to do is you're going to have to affiliate them. And that might make you ineligible. So you have to watch out for this. Now remember, there are exceptions to the 500-person rule. And the exceptions are when you're less than 5 million of income annually and less than 15 million of tangible assets. That's going to put you in a good spot. Now, page 12, who is not eligible? That is the million-dollar question here. Businesses that are not eligible for PPP loans are just identified under these regulations and described further in the SBA standard operating practice. An example would be any type of business that is basically an illegal business. So you cannot, if you have a business, for example, that maybe is legal under the laws in certain states like Colorado, but illegal under federal law, you're not going to be able to participate in this program. Up on page 13, Jonathan's going to walk us through what businesses are ineligible for SBA loans. Jonathan?
Can you hear me?
Take this, or would you like me to?
Bob, can you hear
Can
me?
you continue?
You guys,
Yeah, I can hear you,
you're on,
Jonathan.
Please go ahead.
okay, there seems to be some tremendous
We can't
delay
hear
here
Jonathan. Just
between,
keep going.
people doing things. The-
All right. Jonathan is not coming through. Jonathan, if you hear me, you should just hang up. Bob, are you on? Can you just keep going? Because we have to get through the program, and this is not working. Bob?
Sure, of course. Okay. Okay, everyone. We're on slide 13, everyone. So
Okay,
these are some of the ineligible businesses, and you can look at this and so, for example, banks, finance companies, factors, passive businesses owned by developer landlords that do not actively use or occupy the assets acquired or improve with loan proceeds, life insurance companies, businesses located in a foreign country. So there's a long list here. Skim this at some point in time if you have anyone that you're worried about how they're going to fit, and then you're going to have to investigate how they fit within the four corners of this. Okay, page 14, payroll costs. What are payroll costs? So salary, wages, commissions, tips, leave, paid leave, healthcare payments, retirement benefit payments, and some independent contractors. So what goes into salaries, wages, and commissions is a very narrow what you got paid in cash compensation. Now, then you add to that your health care payments and your retirement benefit payments. So that's all going to come together. The statute, strangely enough, says some independent contractors. However, then the regulations come along and they basically scratch out independent contractors and they put the independent contractors in their own little box. Now, on page 15, we go through what are payroll costs. And basically, if you look at the list, it's a long list, which includes vacation, middle of the page, vacation, parental, family, medical, or sick leave, allowance for separation or dismissal, payment for the provision of employee benefits consisting of group health care, including insurance premiums, retirement, payment of state and local taxes on compensation of employees, and for an independent contractor or sole proprietor, wage commissions, income, or self-earnings from self-employment or similar compensation. That is what makes up your basic payroll. Now, if you go up to page 16, here's the catch. Cash compensation in and of itself, once you get to $100,000, stops. So I'm up on page 16, please. And once you get to $100,000, you stop. So if Susan was making $150,000, you would only count the $100,000 that she actually earned, the first $100,000 she earned. But if on top of that she received health care benefits worth $20,000 and retirement benefits worth $30,000, that's going to push her up to $150,000 of total payroll costs. Even though compensation might only be $100,000, her total payroll costs, when you include health care and retirement, are going to drive her further. Now, looking at page 17, payroll costs through this guidance is basically, is there anything that expressly excluded from the definition of payroll costs? And then they carve out any compensation of an employee outside the United States, cash compensation of an employee in excess of an annual salary of $100,000. Federal employment taxes imposed or withheld do not reduce gross compensation. So again, Marty mentioned this, but it's your gross compensation. If my salary is $98,000 a year, I'm going to put, when you do the calculation here, you're going to put $98,000. If you look at the next page, page 18, now the government is basically saying payroll costs do not include payments to independent contractors in the most recent pronouncement, but it's not certain what is consistent with the statute. And they go through all this. Now, what is very clear, though, is payroll costs do include, they expressly say this, retirement plans, including defined benefit and defined compensation. So they include both defined benefit and defined compensation. If you go up to page 19, we ask the question again about what about independent contractors? And no one's exactly sure how this is going to work. Now, in the easiest world, you have someone that's a programmer for an independent programmer for one of the big tech companies. They sit in their apartment, they have absolutely no expenses, and they receive $10,000 a month. What is their payroll costs? Their payroll costs, if they didn't have a retirement plan and they say their spouse had the health insurance, their maximum would be $120,000, but then we have to adjust that for the next rule, bringing that down to $100,000, okay? And basically, these individuals can submit their own PPP loans. That doesn't seem to be a problem. And they confirm this right in the second guidance, where they say independent contractors have the ability to apply for a PPP loan on their own, and they don't count for purposes of the borrower's PPP calculation. So basically, independent contractors count as employees for purposes of PPP loan forgiveness? The answer there is absolutely not. They do not count as employees for this purpose. Now look at page 20. So we do have this interim guidance, and we basically subtract any compensation paid to an employee in excess of $100,000. We realize this. Or any amounts paid to an independent contractor or sole proprietor in excess of $100,000 a year. When they'll come out with some regs that will clearly clarify this. Look at page 21, please. Now, let's get into this formula. So you do the math for a client of yours, you add up all their payroll for a year, and say that payroll for a year came to $1,000,002, and no one was over $100,000. You take $1,000,002 divided by 12, and you'd come up with $100,000 average per month. Then you would take the $100,000 average per month, multiply that by 2.5, and that's going to give you a loan of $250,000. So you'll share this information with the bank in a format they ask for it, and then they're going to transfer a loan of $250,000 to you. That seems pretty easy. Now, what's going to happen there is that's the beginning of this journey. That is the amount that you can borrow. Now, on page 22, we do talk about that Congress was very smart here. They made an allowance for seasonal businesses. They also made an allowance for new businesses, okay? So they've covered new businesses and seasonal businesses. Now, how do you count 12 months? You can take the 12 months prior to applying, which would include the beginning of 2020, or you can take calendar year 2019. Those are your choices. Now, looking at page 23, again, remember FAQ number 9 deals with seasonal employees, and those with outstanding loans can also have special rules, and new businesses are going to have special rules. Now let's go up to page 24, please. Okay, if you look at page 24 of the materials, where we are here is what are you allowed to use this money for? So here we go. This money drops into that bank account, and then what can you spend it on? It's going to be the things on this list, which we're going to go through in just a second. Now, what we've been suggesting to people is they use a separate bank account. The SBA is undoubtedly going to hire new people to audit some of this, or at least do enough random audits to keep us all on our toes so that we know things will be looked at. And in all likelihood, many times when you have these things, the people that they're going to hire will not have accounting degrees, and they're not going to know how to work, review a general ledger system. They may not understand that. But that's why if you use a separate bank account where you can just say, okay, I took out this money to pay payroll on May 14th. We paid our health care on May 18th. We paid a lease on June 1st, et cetera, et cetera. You can see where you can tie this out. You can show an invoice. You can show the removal of the money from the account. Make it very easy. So I would suggest we use separate accounts. Now you can use this for payroll costs, group health care benefits, and then you can also use this for the payment of, and I'm still back on 24, please, payment of interest on any mortgage obligation, and then rent on a lease in force before January 2nd. Utilities, so those are all the things that go into play. Now, you're also in play here will be retirement plan benefits. That's a subset of payroll costs. Okay, look at page 25, please. Now, to get in this program, there's no requirement that you can't borrow somewhere else. So you're certainly allowed, even though you could get other loans, you're still eligible for this program. One of the things with SBA loans is for a long time, you could only get the loan if SBA was a lender of last resort. Now, the loans are non-recourse, except that the proceeds are used for an unauthorized purpose. Think about this. So you have a non-recourse loan, but if you get off that list where the unauthorized purpose list, then you have a major league problem because that loan then becomes a recourse loan. Now, what I want to do is for the CPAs on the call, you'll be doing the lion's share of this work. But when it comes to signing that actual loan document, what I've been telling all my CPA colleagues is to have the client's lawyer review that, or have the client's lawyer hire a lawyer that does a ton of bank documentation. The banks are not using an SBA loan form. They are using their own form that they've drafted for this purpose. And how are they going to build that form? They're going to start with another form. And what you don't want to do, what you can't have happen, is that somehow the bank, consciously or unconsciously, puts a provision in here changing the recourse or the personal guarantees. And you do not want your client in a trap like this, where suddenly what they thought was a non-recourse, non-personal guarantee becomes a personal guarantee, and they're in trouble. Okay, because the way this program is structured, there will be some people in this big country that say, I'm probably going to go bankrupt anyway, but I'll try. I will try really hard to use this payroll protection program. We'll give it one last shot. People wouldn't do that if they had to take on all this risk. They might know that they should walk away. Look at page 26. One thing for the CPAs, ask yourself for both partnerships and for S corporations, how are you eventually going to get this money out of the corporation to the shareholders and to the partners? Because we're not sure right now whether this tax-free debt forgiveness is going to help you create any basis, or whether it's going to help you with your other adjustment account in the S Corp world. So just put that out there in both S Corps and partnerships. How is this going to play out? So we definitely want to know that. Look at page 28, please. Good faith certification. Your clients are going to be asked to sign a certification, a good faith certification. And this is going to be something that where you agree that or you acknowledge the current economic uncertainty makes the loan necessary to support ongoing operations. I'm actually up on slide 28, please. The funds will be used to retain workers and maintain payroll. And then we also have that there's no duplicative amounts. So you basically have to say you need this money to keep yourself up and running. Now, what is fair and what is not fair? Who can, for example, if you're an accounting firm, you might say, well, I've got a lot of receivables right now. I think my clients are going to keep me pretty busy. I don't know if I need this or not. But look at what was reported broadly yesterday. They went through the big four firms worldwide plus a handful of next tier firms, and they showed all of the pay cuts they were implementing for their partners and for their senior non-partner leadership teams. And at the end of the day, they're big cuts. And that must tell you, well, if the people at the top of the profession running these big firms are anticipating that there'll be less work, why wouldn't the rest of us believe that? Okay, that just makes sense. There's a lot of economic contraction. If anything, there'll be less mergers and acquisitions that are happening, so work is going to go down. So of course you would say good faith certification. I don't think that's that hard to sign. Now let's say you get forgiveness. Go up to page 29. Once you have forgiveness, what's going to happen is the remaining balance after forgiveness will be guaranteed by the SBA, and then a PPP loan can be used to refinance also an economic injury disaster loan too. So you can get these loans. That is not that big of a challenge, but guaranteed by the SBA unless you've used it for an unauthorized purpose. Now, if you look at page 30, please. So these loans are going to have terms, interest rate of 1%, deferment for 6 months, and then you have to repay within a 2-year period of time. This is where we are today. They've changed the interest rate on this 3 times, and now they've settled at 1%. The SBA is doing a lot of things you would never see the IRS do. The IRS, and we probably don't appreciate it enough, they pretty much stick to the statutes. I know that real experienced people can say not always true, but the SBA is not following the statutes at all, and we see that in a number of places along the way here. If you look at page 31, some clients will take this economic injury disaster loan. Just because you take this economic injury disaster loan doesn't mean you're barred from the Paycheck Protection Program. You can still enjoy the Paycheck Protection Program. Now on slide 32, let's jump up to 32 and talk about loan forgiveness. So we go through this 8-week period of time. And then what happens during that 8-week period of time is you'll have payroll costs, which could be actual salaries plus health care plus retirement plans. You're going to have mortgage interest, you're going to have rents, and you're going to have utilities. Those will be the things that are going to stack up during that 8-week period of time. That will be the beginning of what's possibly forgivable. So just write down payroll costs plus mortgage plus rent plus utilities equals what's possibly forgivable. On page 33, very quickly, the banks do not need to audit any of these numbers. Okay, banks do not need to do any verification of the borrower's information on loan forgiveness. So they just do not have to do that. 34. So now when we get into forgiveness, there are going to be 3 mathematical equations we have to work through. Write these down. There's going to be the full-time employee ratio test. There's going to be the salary test. And then finally, there's going to be the 75% payroll test, okay? So you're going to have 3 different tests, and I'll walk you through each of those. Now, the first one, and it's going to be almost impossible to get through all these tests, okay, without losing some forgiveness along the way. Many people believe there's a mathematical flaw in the whole thing, in all these forgiveness equations, that where a person could never receive full forgiveness. So you look at how many employees did I have during my 8-week period, and then how many employees did I have? That goes in the numerator. In the denominator of the fraction, it's how many employees did I have from February 15th, 2019 through June 30th, 2019. So that is the beginning. Now, if you don't like that equation, if you don't want to use the 2019 denominator, you can actually jump up one page on 35, and you can use a slightly different fraction. You're going to be able to use the period of January 1st, 2020 through February 29th, 2020. So again, you can pick which of those fractions work better for you. Your goal is going to be to get the denominator as small as possible. Okay, so that's going to be your goal. Now, then there's your salary test. Okay, and that's up on page 36 of your materials. When we get up to 36 of the materials, we have the salary test. And basically, if you reduced everyone's wages by more than 25%, you're going to have to take a haircut on your forgiveness. Okay, so now, again, if you took one of your more senior people, they're making exactly $100,000, and you reduce or $99,999, and you reduce them to $74,000, a cut of more than 25%, you're going to lose some of your forgiveness. Now, what no one knows right now is whether we do these calculations in series or in parallel. And that's what the SBA regulations are going to have to clarify. Now, the other thing that they do is there's an overall test, though. Go up one more page. This is the good part. If you rehire everyone within 30 days of enactment, you are going to be able to walk away from any punishment under the full-time equivalent test or under the salary reduction test. So that's the good news. If you can get everybody back in their spots, you'll be in a much better place, okay? So you're going to be in a much better place. Looking up to page 38, here's the really great news. Right in the statute itself, is a forgiveness clause that says any amount that's forgiven is not taxable. But yet nowhere else in the statute do they say the expenses that went into allowing that forgiveness are non-deductible. They don't say that anywhere. So they're going to give you the income on a tax-free basis and then allow you to take a deduction for the salaries and utilities, etc., that support this deduction. It's a very generous move by Congress. If you go up one more page, how are you going to apply? The smartest move is to go to your normal bank. Okay, so your smartest move is going to go to your normal bank.
Bob?
Marty has been working really hard on this. There are a number of difficulties with the... Yes, Marty. Go ahead, please.
Why don't I try to take a few slides and then turn it back? But I'm not going to bounce back and forth much because the technology is just not working the way it should. And I apologize to everyone on the webinar. We can't control what's going on with the internet. On slide 39, so let's go through the basics, and I'm going to give some comments because I've had a lot of people email me with questions on this. The loans are not made through the SBA. People have emailed me, they're trying to apply on the SBA website. No, you have to go to a commercial lender. What I think most people want to try to do, because many banks are requiring that you have accounts with them or be a customer. So start with the bank that you, if the loan's for your practice, that you bank with, or if it's for a client, they should start with their regular bank that they do business with. If for any reason that doesn't work, on the SBA.gov website, they have a list of approved lenders, and lenders presumably are signing up. What I actually did, I tried to start with my bank, and it was back and forth. I couldn't get a response. They've been struggling internally. I mean, this stuff is all happening so fast that not only are our clients struggling, but we as practitioners are struggling. The announcements of new interpretations and FAQs and regs and stuff keep happening, and lenders are struggling. What I finally did is when my bank couldn't come through, I went to a bank that I've referred a lot of business to, another bank I deal with, and they, as an accommodation, let me in and let me open an account so that I would be a customer and meet their requirements. So there's not an easy answer to that, but I think you need to persist, because unless they add to the $349 billion bucket, once these dollars are gone, they're gone and you lose out. And as Bob explained, to have money that you can get, that you can use to pay expenses, continue to deduct the expenses, and have no recognition of income on forgiveness, it's just too sweet of a deal to lose. And many of us and many of our clients are going to desperately need these funds to keep going, because we don't know how long any of this is going to last. In the middle of page 39 are the two dates that this started. On the bottom, how do you do it? There's a very simple PPP loan application. It's SBA Form 2483. Bob's going to show it to you in one of the slides coming up and just go through some of it. It's really not that difficult to do at all. The part of it that takes a little thought, which is why I think professional advisors will be necessary, is how do you calculate the wages subject to the 2.5 multiple? You have to make sure you cap people at 100, but that's only for a cash compensation. You can add to that the other types of perks that Bob talked about, like health insurance or retirement plan benefits. If you're seasonal or just started a business, it gets more complicated. Do you use the prior 12 months or 2019 data? I opted for 2019 data, even though I think my numbers would have been a little higher using the past 12 months, starting with like March of 2020, because I just wanted to make it simpler. I didn't want to make it more complex for the bank to approve it. And having W-2s and 941s where it's all simple from the calendar prior year just made it make sense. Now, Bob already mentioned this, but it's important to repeat. If you're familiar with SBA loans, in the past, you generally had to try to go someplace else, get rejected, then go to the SBA. That's no longer an issue at all. Now, what do you have to certify in the application on slide 40? You have to certify that current economic uncertainty makes it necessary to get these funds to support your ongoing operations. Bob and I spoke back and forth about this. We really came down with the conclusion that everybody should be able to make that certification. Nobody knows what the impact on their business is going to be, not a client, not a professional advisor firm. We don't know how long the stay-at-home orders are going to be in place. So it certainly seems that anybody can, in good faith, certify that. The funds have to be used to retain workers and maintain payroll, mortgage, lease, the qualified payments that Bob talked about. You're not going to get another loan under this program. You'll provide the lender with documentation that verifies the number of full-time equivalent employees. That's, again, where the calculations that Bob walked you through, I think a professional advisor can help many clients. Loan forgiveness will be provided for the sum of documented payroll costs, covered mortgage interest payments, covered rent, and covered utilities. I think Bob's idea is practical and brilliant. Open a separate bank account. I'm in the process of doing that for my practice. I'm going to pay rent and other things out of that account directly so that I have direct correlation receipts. Payroll, I'm not going to pay out of the account. Rather, I will reimburse my general business checking account, because for 2 months of time, I don't want to change what is an automatic payroll deduction from the business account to another account and go back and forth through the paperwork, but I'm going to have direct dollar for dollar proof of what it is. And I think that's what you want to do for your practices and what you want to do for your clients as well. You have to acknowledge the lender will calculate the eligible loan amount using the documents submitted. Now, let's go on. What are lenders requesting? One of the issues here is, what is it you have to attach to the application? What I did is I showed all the supporting calculations, and I gave W-2s for each employee, because then it all ties out and shows the exact numbers. I had to get all the receipts because I wasn't sure how else to do it, to show proof of what was paid for health insurance and retirement benefits. I added those up and I showed it all like on a little Excel spreadsheet and came up with the numbers, divided by 12, multiplied by 2.5, and came up with my dollar figure. That being said, on slide 42, I have a list of the documents that one bank that I talked to is asking their customers that are borrowing under the PPP program to submit, and it's really rather substantial. The bank that I went to after I submitted what I just said, which I thought was more than adequate proof, still wanted an income tax return for my practice for the prior year. And they may ask clients and be asking all clients for that. So one of the problems is banks don't have to do any kind of forensics or audits. They don't have to document anything other than the basic information to prove it. And you'll see in the statute a lot of very lenient language to help get these funds done. But nonetheless, banks are used to operating in a certain fashion, and it's probably easier to simply give whatever's asked for than to try to get them to realize that they don't need to ask for some of that. On slide 43, I talk about some of the language in the guidance that was issued just recently by the SBA. You have to submit such documentation as necessary to establish eligibility. Borrowers that don't have such documentation can provide other supporting documentation. It seems pretty clear that the minimal to make a good faith effort of showing it is all that's necessary. But again, many banks are asking for more. Slide 44, and I put this here too in case you're getting some difficulties with the bank, you can show them this. It's just excerpt from the interim guidance that was provided April 2nd. And I highlighted, it is absolutely clear this is supposed to be done quickly, expeditiously, immediately, streamlined requirements, and so on. Maybe that'll help you if you run into a problem. Bob, I'm going to turn it back to you on slide 45.
Well, thank you, Marty. So let's just start with a little example that might help us to wrap our mind around how this works. Focus on the concepts here so we can start thinking about how might this play out. So pretty typical situation, you're helping this garden supply store, 27 full-time equivalent employees, annual payroll is $1,883,000 a month, and how much of a loan are you going to be eligible for? You're going to take the 83,000 multiplied by 2.5. 208,000 will be the amount of your loan, give or take. Now, the store only kept 5 key employees on the payroll in order to close. And they're paid together $340,000. So let's look at the next slide. Now, what's going to happen is this: you begin with an $808,000 loan, but during the 8 weeks following when the loan was dropped into your bank account, you spent $130,000. So that's rents, utilities, interest, and those salaries. So the most that would ever be forgiven right now would be $130,000. But let's jump up ahead. Let's say you brought some people back, and bringing those people back costs you $39,600. So now your total for potential forgiveness is $169,000 of the $208 borrowed. So already there's almost $40,000 that has almost no potential of being forgiven. And now they're thinking of changing that ratio from 2.5 to 3.5. That will expand the amount you can borrow, but it's not necessarily going to expand the amount that you can have forgiven unless they change these equations. So we spent a lot of time working with these equations. Let's go up to 48 and talk about the 3 ratios that we're up against. We're up against the employee headcount ratio. So in this case, basically, you have 169 of potential forgivable expenses. You multiply that by the amount of employees that are no longer working for you, and you're going to have potential you're going to lose some forgiveness to the tune of $100,000. Then you're going to have a reduction in this second headcount for reduced wages. If you brought anyone's wages below 75% of what they were making before. So you have somebody making $50,000, you say, you can come back to work, but I can only pay you $35,000, 70% of what you're making. What do you want to do? And if they came back to work, you're not going to get 100% forgiveness with regard to that person. That's a shame, okay? That's just something that they put in here. Now, if you look at the next page, though, on page 49, please. Now we get into the actual Paycheck Protection application. Okay, average monthly payroll is not a hard figure. That's a very easy figure. It's your salaries plus your retirement plans plus your health care benefits. That's going to get you to that place. Then you multiply by 2.5. That's not hard. And then number of jobs. So the SBA counts jobs in that if you were running a grocery store and you had 40 managers, department managers, full-time day people, and then you had 120 young people, 16, 17, 18-year-olds, each of those part-time people would count as a full person. So you'd have your initial full-time employees plus all your part-time employees. That would be one number. And then so that's the number that goes in that little box. And then the rest of the form is pretty straightforward. Okay, the rest of the form is pretty straightforward. The certification that we spoke on is also in that form. So the certification is right in that form. Let's look at page 50, please, 50. So you can see, you go through this, there's nothing too tricky here. Just you are going to sign it under penalties of perjury and under penalties of criminal prosecution. So they are not playing here. If you fill this out wrong, if you deliberately mislead the SBA, you are going to get yourself in major league trouble. And you know they're going to have the most blatant people that do this will be prosecuted because a message needs to be sent to all of us that, we need to adhere to the law. And okay, now 52. If you jump up to page 52, this is your economic injury disaster loan. This loan can be up to $2 million. And there's nothing to prevent you from taking this loan along with your payroll protection loan, okay, or paycheck protection loan. If you look at page 53, remember in your EIDL loans or grants, they are forgivable. Okay, the first $10,000 of this will be forgivable. And the government's supposed to be able to get you that money within 3 days of applying. So it's supposed to be able to get you that money within 3 days of applying. If you jump up to page 55, a couple other things. If you can't participate in the forgivable loan program, you might want to opt for the employee retention credit. And the goal of the employee retention credit it's pretty simple. It's that what's going to happen is you're going to get 50% of qualified wages up to $10,000. So if somebody made $10,000, they would get a $5,000 credit. Okay, so that would be how this would work. That's the cap. Again, you cannot get the employee retention credit if you are going to take the SBA forgivable loan. That's just not available. Now, the other thing on page 56, the other thing you may have heard about is that people could actually delay paying the employer side of payroll taxes. And they can delay that until December 31st, 2021. And then the other half can be delayed until December 31st, 2022. Finally, there on the refundable employer FICA, there's another credit from the Families First Coronavirus Response Act on page 57, and that's for employees that are sick and employees that are required to take family leave to care for a sick family member or to take care of a child following a school closing. So you do have all these things out there. And finally, a little bit on additional employment benefits. There is an additional employment benefit available, page 58. Independent contractors and gig workers will now qualify. And this is an additional $600 a week above, my understanding is, this is above what the state is giving you. So this can be, this is going to be a very big benefit for some people in lower level jobs. They might, one of the concerns is that they would be paid more considerably more than they would make working. If you remember, Lindsey Graham was on the Senate floor talking about this, how he was being told by his small businesses in South Carolina that people wouldn't want to come back to work, that they would be paid more to stay home, and that ship has sailed. Okay, so that was part of the bill. Now on page 59, the CARES Act enhances health insurance coverage to address costs associated with the coronavirus, and basically testing and diagnosis without deductibles. And once we have a vaccine will be provided without deductibles or copayments. I'm not so sure the word on this has gotten out, and for the lawyers listening, this is maybe where you have to knock very loudly on people's doors, and because we had a situation here where this is all alleged, but I heard it third hand, but there's this young man we know, and he said that his girlfriend was exposed and that it was $1,500 to be tested, and her health coverage wouldn't cover that, so she chose not to get tested. And that was, and she did not self-quarantine either, which was a real shame. And at the end of the day, that's exactly the behavior, exactly the opposite of the behavior that all of us need to have in order for us to stamp this thing out. So also they made a modification that telehealth services can be covered under health savings accounts. So that's out there too. Okay, finally on page 60, remember employers can make payments to employees to address the economic impact. If the payments qualify, they won't be taxed as compensation to the employee, but they're still fully deductible by the employer. That's IRC section 139. So here we are in summary. Small business, what can you possibly do? You can use those paid sick leave credits, you can use the Paycheck Protection Program, and you can use the disaster loan program. On larger businesses, where we are is FICA tax credits for employee retention and FICA tax deferral. So this is all out there and very critical. Finally, on the last, I just laid everything out here with this little slide, and what you have is you have this period of time where we have to compute your average monthly wage. Okay, so that we have to measure that, and that could be all of 2019, or it could be from April 1st, 2019, for example, through March 31st, 2020. And then you have 8 weeks where you're going to measure your spending, and then that will spin into what is going to be forgiven. They did also issue a notice that they're not going to allow you, once you've applied and that's in motion, they're not going to allow you to delay receiving that. So we have covered a lot of ground. Marty, I'm going to bring this back to you, and then you can tell us where we go from here.
Bob, can you hear me okay? Because what I think we should do is answer some questions. I got a lot of emails. It seems like the internet issues, maybe it's weather related, have gotten better. And again, I apologize to all of you on the call. So here's a question from Grant. If an employee is currently paid quarterly, should payroll frequency be switched to bi-weekly to ensure the borrower can show that the loan was used to pay an employee during the applicable time period? Bob?
They seem to be, doing this on the cash basis of accounting. There's nothing in any of this that would put you on the accrual basis of accounting. So my answer to that would be yes.
So you should go to a more frequent payroll period to make sure that it's covered. And that makes a lot of sense. Another question from Grant. How will banks evaluate whether a borrower used the funds for the permitted purpose? Will they require tracing of the funds borrowed? It seems problematic if the loan proceeds are deposited into an operating account where they'll be commingled with business revenues. So I know you spoke about this in your recommendation of a separate bank account, but maybe you just want to comment because it's a good question.
Well, yeah, no, Grant, that's a good question. The simplest way to do this is going to be to set up a completely new account and just use that account to just use that account all by itself to pay these things. And like Marty said, I think if your payroll is $8,412, you move that from account A to the account you normally have it pulled out of. But you make it so that the bankers and the anybody from the SBA could easily see this. I mean, just lay it out so that you can go through and match everything up. And that's going to reduce any concern on any of these agencies' parts.
Yeah, I mentioned what I'm going to do personally for my practice. I'm opening a separate account. I'm going to deposit the PPP loan into that account. I'm going to pay rent and utilities directly from that account, and healthcare insurance as well. And for the things that are on auto pay and automatically deducted from my regular business checking account, like payroll, I'm not going to change them because it's just too much paperwork to do, and I don't know how fast that will be accomplished. I'll just write a check from the new PPP account to reimburse the operating account and save the backup so that I'll have the 6, 8, 10 receipts to prove precisely it. Here's a question from Mariana, Bob. Somebody's working as a sole proprietorship and they don't have payroll. How do they figure out what's their payroll?
I think it looks something like this. So you have actual payroll to your workers for 5 workers, part-time people, of $200,000. So there you go. That's part of it. You yourself, your sole proprietor income on Schedule C was another exactly $100,000. So now you're at $300,000. You divide 300 divided by 12 is 25. 25 times 2.5 would be $62,500. I think that's exactly how you're going to do this. Now, it's kind of unfair compared to if you were an S corp, because what happens in this particular set of equations is all your bonus depreciation and your 179 depreciation are going to come into play.
Bob?
Yes.
So here's another question from Claude. It's too long to really go through, but let me just paint the scenario. Client's working as a dentist, had to lay off 2 of the 4 staff people because he's not an essential service, has no income coming in. What does he or she do?
Well, dentistry is really tough because pretty much stopped except for emergencies. And if you're not paying people, you're not going to really be able to, you can get the loan because that's based on last year, but you're not going to be able to get to the forgiveness part. Now, I think some dentists I've read are, maybe keeping 1 or 2 people on to, just help with, there's always projects in a business that need to be done that you never get to, that kind of thing. Or you keep your office administrator around so that he or she can chase down bad receivables and things like that. But it's very hard in a business like that where the federal or state governments are saying no normal dental work, only emergencies. I don't know if that was responsive, Marty, but I think dentistry is the toughest one out there.
Yeah, no, I think it's tough, but I think your thought is that if you do have administrative projects, whether it's receivables, organizing the firm website, whatever, keep somebody on the payroll and calculate what that's going to be. Maybe you take a reduced loan, or take the loan because it's only a 1% interest and the amount forgiven will be less, but at least you can use the forgivable amount of the loan to pay some skeletal staff to do some admin work. Here's a question from Lou. Somebody's structured as an S corporation, but they never took salary. So they probably have FICA and withholding and other issues already, but that's not our topic today. My belief is if you're an S corp owner and you've never taken a salary, you don't have anything that you can calculate in terms of your earnings because there's been no salary. How would you think?
Clearly. Your greed on the front end of not wanting to pay any Social Security taxes coming back to hurt you later.
Right. So I've seen people set up S corps because they claim their accountant told them that they can take out, $1,000 a month or something as a salary, and that's all they have to do. and they're an S corp, so they don't have to pay withholding tax, FICA, and so on and so forth. They're going to get hurt. So yeah, just like you said, Bob, the greed or the inappropriate tax positions earlier hurt them later. No, this one we did. Let me see, I got another one coming up. So here's another one on Schedule C. A bunch of questions on Schedule C because they don't have payroll in the traditional sense and they're trying to figure out how to calculate it. So this is one relating to a sole proprietor in the PPP loan. No employees, no rented office. They have a home office. They're not paying themselves rent. They were a consultant that received 1099 income from a whole bunch of different customers. The business ground to a halt after COVID. So now they really don't have any business during the 8-week period. They have no coverable expenses. But what if they took out a loan and paid themselves the same salary, but it's using the loan to do it? Does that work? Is that possible?
I think so.
Even though they have no income on Schedule C?
That's correct. Well, if they're sole proprietor, yeah, if they're sole proprietor, that wouldn't work because you had no income. But if it's an S corp or a partnership and you're paying employees, now if the sole proprietor paid employees during that period, you would just have zero contribution for the income of the proprietor themselves. Whether or not they would force you to reduce everything else by a negative, quote unquote, salary of the proprietor, I can't believe you could have a negative salary in this theoretical equation. That wouldn't seem right.
No, that doesn't seem right either. But one of the things that we mentioned earlier is that we're expecting more guidance from the SBA on forgiveness and some of these other concepts, and hopefully that will help us. Here's another question. How will banks evaluate what we used? I think it was similar to the other question, so I think we've covered that. Let me see if I have any others. I think that may be about it. I'm sure there's a few more. Maybe here's another one from Neil. Assume you're a lawyer who's a sole proprietor. You apply for and get a PPP forgivable loan, which you use to pay yourself. Is it a problem if you also collect client receivables during the same time period as a loan and are used to qualify for forgivable status? I'm not sure what that's referring to.
Well, if you're a lawyer,
can you decipher that?
Yeah, if you're a lawyer, you would have receivables coming in. If you're a sole proprietor, those receivables would create income for you because you're on a cash basis of accounting. So, yeah, theoretically, your law firm could be totally closed and still be profitable, and that would give you income on the sole proprietor test,
which would be the equivalent to salary, so that you could use that for the forgiveness calculation.
Exactly. I think that's right.
Yeah, I think the practical problem, all professionals are going to struggle with collections now because so many clients are in such desperate condition and their revenue streams have stopped. Even though I think lawyers and accountants are wonderful and important, clients are going to view things like rent and utilities perhaps is more important than us. So collections are clearly going to be an issue. So keep that in mind. Here's another question. I'm not quite sure what it means, but maybe you can comment. I think it's just more on Schedule C, which I think a lot of people are just conceptually struggling with. Do you support entitlement via Schedule C of your personal return for the PPP loan? And is it relevant number gross revenue or net revenue from the business?
Well, if you're a sole proprietor, it's going to be net revenue. Gross revenue never comes into play. It's always after expenses.
Okay, here's another one on sole proprietorship. Can you discuss the difference between sole proprietorship and self-employed persons? Is it the same thing?
Same thing.
Okay. Here's another one. What if the employee you wanted to come back to work 30 days prior to the deadline doesn't want to come back? They don't count, I think is the answer.
They do not count, right?
Like somebody was suggesting, this is a question from Paul, that you could bring back any people, not just the people you had employed before. It didn't have to necessarily be the same employees. Do you read it that way, Bob?
Would you repeat the question, please?
Yeah, if you want to use that 30-day deadline and bring back employees, I guess the question is saying, does it have to be the same employees? What if they don't want to come back? Can you bring back different people as new employees?
How could it possibly logically be the same employees? Because if you just ponder this a little bit, I mean, if you have 400 employees, you're going to have all kinds of different circumstances. And there's no way you're going to be able to get all 400 back even if you wanted them. Because the world will have changed. Kids will be off school. I mean, we could go for a half hour on why people might not be able to come back.
Any other comments or suggestions, Bob?
No, I think there's a lot going on here. Pay very close attention this week because undoubtedly, hopefully, the regs will come out. Even while we were on the phone, the IRS made some big 706 announcement. I haven't read it yet, obviously, but somebody brought me a note on it, not knowing the class I was teaching. So there's a lot going on here. There's going to be many more changes. This is one of the more dynamic things. And just be very skeptical of what the SBA is coming out with. They are working very hard, but they are not as disciplined as the IRS. And I think like the 75% forgiveness test, 75% of your forgiveness has to be payroll. That is a made up notion. That is not something that's anywhere in the statute. All the experts agree that that's something they just made up, and they probably can't do that. That's probably beyond the arbitrary and capricious standard. So there'll be a lot of litigation that follows this. So Marty, back to you.
Yeah, let me give some practical concluding comments. There are just endless questions and interpretations, and we tried to address a bunch of the questions and a lot of the points here, but let's keep some key points in mind. If you don't get an application in for yourself, for your practice, and you should, if your clients don't get their application in, you may just lose out. So, while we as professionals, whether you're a wealth advisor, attorney, accountant, we're all trained. It's in our blood to want to be technically accurate. We love precision. We love citing to a source and saying, this is what it is. The SBA, the banks, everybody is struggling with this massive situation we're dealing with, the complexity of all this. The intent is right to try to infuse funds into small businesses to keep them going. Don't get hung up on looking for correct answers and end up missing the boat. Get applications in. That's critical. Second, you got to start the process, and your clients have to if you haven't done it already, because the first bank you call may have already used up whatever they're willing to do, or they may be so backlogged you can't get in the door. So get going on it. Second, Bob pointed out, and he scared the shoes off of me with it, they're really serious. If you do this stuff wrong or you misrepresent on the application, this thing is got really severe, harsh potential penalties. I think it makes a world of sense for clients to have a professional advisor. I don't think it's a great deal of work, but it's certainly good work for advisors. But if your independent accountant or advisor calculates the payroll, puts the backup together, and they've done this kind of work millions of times, they're much less likely to make a mistake than a client who has no real accounting or business background doing it. So get your professional advisor. If you're a professional advisor, tell your clients to let you help, because they don't want to sign this document under penalties of perjury with potential criminal penalties and have done it wrong. Once we get the money, which should be the first priority, the next is to make sure that we can all document how we spent it. And Bob is giving you some great ideas, and I've told you what I'm doing personally to try to do that. Once all that's done, then we can start turning our attention to what's going to be forgiven and how to make those calculations and that analysis. And hopefully before we get to that point, hopefully before we even get the funds in, we'll have more guidance from the SBA on forgiveness. But I think this is really a critical time. No one knows how long these difficulties and these stay-at-home orders are going to be in place. So we should all use whatever efforts we can to get these loans for ourselves and our clients and document them carefully. If the significant new guidance is different, Bob and I and Jonathan will try to redo another webinar. I again apologize profusely to all of you about some of the technical difficulties. It was nothing on our end. It's possibly weather. It's probably just bandwidth due to so many people now working remotely as compared to what it was, a month ago. So I appreciate you sticking with us. We will post a recording and all the materials on shankmanlaw.com. I want to thank Peak Trust and Interactive Legal for their sponsorship. The American Brain Foundation, who made a quick plug, was a charity certainly worthy of support for you and for your clients. Wonderful organization. And finally, just in closing, we've tried to do something this webinar, which I've not done before. I would welcome any input from any of you, feedback. That we had the webinar, I'm going to use the wrong term, signed, and that's not the right term, and I apologize, interpreted. And that's something that if it worked out well and was well received, and you could always minimize the screen if you didn't need it, but I thought was a wonderful thing to do, and I appreciate any feedback on that, because that's something then we can try to do for all future webinars to make them accessible. Thank you for joining us. Good luck. And stay safe. Thanks, Bob. Thanks, Jonathan. Thank you, everybody.